Hello, this is Blaine McCormick from the Baylor Business School, and welcome to What's the Situation? This is a brief tutorial about the situational analysis for the Foundation Business Simulation, and the goal of this video is to help you complete this starting assignment with the richest context possible. If you don't understand why you're doing it, it's just a bunch of dumb numbers that you're filling in, but if you grasp the calculations you're doing, this will give you a competitive leg up as you engage in the foundation business simulation. It's kind of like learning baseball. If you're going to learn this game, somebody will take you out and say, well, there's four bases, and you run around them counterclockwise, and you'll need a bat and ball and some gloves and some uniforms, and this is how you hit, and this is how you pitch, this is how you field, this is how you catch. Three strikes and you're out, three outs, 9 innings. Here's the infield fly rule. They'll try to explain that one at least. And then as you go play your first game, you at least have a better understanding of how this game plays. And so that's what the situational analysis does. And I build my understanding on it around 5 questions, 5 basic questions. And if you can understand the challenges facing your company, the situational analysis answers these questions. One, what does the customer want? Two, how big is this opportunity that you're getting into? Three, how much will it cost to keep up? Four, how profitable will this opportunity be? And five, do they or the customer like our product? And the situational analysis helps you grasp these 5 questions and helps you start formulating answers to these 5 questions, because these are really key for any business to understand what the customer wants and how big the market niche is and how much it's going to cost. These are things you might answer if you go to the bank for a loan or talk to investors who might offer equity investing for your firm. Let's start with the first question. The perceptual map exercise in the situational analysis helps you understand what the customers want. And in Foundation, the perceptual map is on 2x2 on size and performance, from larger to smaller and from slower to faster on here. And let's do it with hotels first. Let's take a hotel 2x2, perceived price and perceived quality, lower to higher quality, lower to higher price. And if you looked at lower price and lower perceived quality, you'd have Motel 6 and Econo Lodge down here in this quadrant. And you'd have higher price and higher perceived quality, Ritz-Carlton and Hilton chains there. And then kind of in the middle, you'd have your La Quinta and Holiday Inn and some of your Marriott brands there in the middle. And you can see how the motel brands map across a 2x2 of price and quality. And as customers are more interested in quality and price, their preferences shift toward Hilton and Ritz-Carlton, where if it's an economic contraction and they're more interested in saving money and having lower quality experiences, then it would shift toward the opportunity would move toward Econo Lodge and Motel 6. In Foundation, you have high-tech and low-tech customer segments, and they always want smaller and faster. They both want smaller and faster electronic sensors, and you'll see your segments move across from larger to smaller and slower to faster. High-tech always moves faster than low-tech, and it goes across like that. And you just need to know where your segments are on this grid so you can hit them. And I want you to think about the segment as a bullseye. And it's going to float across the segment there. And I tell my students, if you can hit the bullseye on your segment, wherever the ideal spot is in that segment, you'll make a lot of money from your customers there. So that's part one. The demand analysis answers the question, how big is this opportunity? Here's a chart from the FCC on wireless data growth across the next 6 years, and you can see it just explodes across the next 6 years to 2014, getting quite big, and that helps us understand what kind of demand we're facing as we go in here. And the demand analysis does that for low tech and high tech. You have your starting demand and your growth rates, and you just calculate um, uh, using your reports there, the growth rates and for low tech and high tech and the starting demand and how fast they're growing, and just go through the rounds. And that kind of helps you understand how big this thing's going to get. And I tell my students, you need to graph demand growth just like the FCC did there, to get a real sense for how big this is going to get, so you can plan accordingly across all 8 rounds as it goes. And then the third part, the capacity analysis, helps you understand how much will it cost to keep up. Let's go back to the rest of that FCC chart. We had the demand growth here at the top, and at the bottom is existing spectrum, and you can see that the surplus disappears by 2013, and so somebody's going to have to get out there and get more spectrum if that's possible. And it's the same thing's going to happen in foundation. You're going to run out of capacity because demand's going to get big, so who's going to build first? And so it's going to ask you to calculate how much it's going to cost to get twice as big and fully automated for your capacity analysis. That is, to double your capacity from this much capacity to this much capacity, 2 lines, so to speak, or double the length, double the capacity of your existing line, and get fully automated, meaning that instead of people making your sensors, you have a robotic factory that makes your sensors. And that's what the capacity analysis does here. It looks at your first shift analysis capacity for your company and the whole industry, and asks you to maximize that by running 2 shifts, and then looks at your the automation level you have, and how much it would cost to double your capacity and raise your automation to 10, or as I put it, to become twice as big and fully automated there. The fourth part of the situational analysis is the margin analysis, and margins are just basically the difference between the price of the product and the cost to produce that product. And there's just some very basic calculations you need to make. If you had a $30 product that had $10 in materials and $10 in labor, that'd be $20. You could see that your contribution margin, what's left over on your cost, would be 1/3 or 33.3%. Or to graph it out a different way, if you had a $30 price, you had $10 in material cost and $10 in labor cost, you'd have a $10 margin, or 33.3% margin, which is a decent margin, but you can get better than that. And that your margin kind of determines your baseline for profitability for the firm in many ways. The final thing is the consumer report, and it asks you to grade your product, your one product that you start out with, very soberly across the preferences for low-tech and high-tech customers. You want to give yourself all A pluses here, but don't do that. Look at the consumer preferences for each segment and say, how do they like our price and our age and our position, and are they aware of us, and what's our accessibility? And use your fast track to do that and give yourself a good sober grade, and that will help you position your marketing efforts for the long run and figure out how you have to move this thing forward. My favorite thing about the Foundation Business Simulation is it teaches users to make good integrated business decisions. And so if we answer these 5 questions, we really see how this cuts across the 4 parts of the firm there. If we know what the customer wants, that helps us position our marketing efforts and create products in R&D that the customer might like, and so it integrates those 2 functions. If we start looking at how big this opportunity is going to get, this helps us position our marketing and production, the supply that we use, that we create to meet that demand. Helps us position those and integrate those with one to another. How much will it cost to keep up? The more production we have to build, we have to get money for that for somewhere. That helps us integrate our production and finance operations there. How profitable will it be? Really, goes back to R&D. How expensive of a product are we making? How much capacity are we buying, and how much are we keeping? Profitability-wise, that's a financial function there. And then the consumer report goes back to the marketing function. Just looking at the 4 P's of marketing, and do the customers like our product, and what do we need to change to get that going? So you can see that Foundation's really going to help you integrate the decision making across those 4 areas, and the situational analysis helps you understand those decisions kind of in your competitive and industry context. So I hope the tutorial's been useful. I have other videos on Foundation on the YouTube channel, and go to those if you want to know more things about the fast track or round 0 or other things like that. Good luck.